There is a risk here that we rerun 98, 99 or 99 because you've just taken all the tail risk. Let's assume that Saudi, the US, and Israel do a deal with Iran. That feels like it's going to happen. Let's say that there will be a ceasefire in Ukraine, and let's assume that the Chinese will come to the table, do something reasonable. Those three things happen. We've taken all of the left tail off the table. And people are going to be like, oh, but inflation's going to come back. And they're going to keep saying that for 18 months, which they kept saying as inflation's fallen. So I think it is not a small probability that we have a really blow off kind of next 9 months or so.
The world stands on the brink of a major shift, not toward crisis, but potentially into one of the most powerful market rallies seen in years. Macro investor Raoul highlights how the geopolitical landscape might be approaching a rare moment of calm. Imagine a ceasefire in Ukraine, a breakthrough deal between the US, Saudi Arabia, and Iran, and a cooperative pivot from China. If even two of these events come to pass, Powell believes markets will have effectively removed their biggest, left-tail, risks, the kind that usually keep investors awake at night. When fear disappears, Powell says the outcome could be explosive. With those major risks off the table and inflation continuing to trend downward despite the headlines, there's a rising chance of a blow-off top, a parabolic melt-up in both equities and crypto markets. This surge wouldn't be driven by fundamentals, but by narrative, liquidity, and pure momentum. Signs of this are already emerging. Positioning remains light, sentiment is skeptical, and liquidity is quietly flowing into the system. Together, these create the perfect conditions for a sudden, sharp upward move. It's no longer about slow and steady growth. Instead, the real question is what happens when everyone simultaneously realizes the downside risks have vanished and rushes back into risk asset. In this video, we'll unpack Raoul Pal's latest interview and explore why the next 9 months could be unlike anything we've seen since the post-COVID bull run. Stay tuned as we dive into the macro setup, the possibility of a banana zone repeat, and what it all means for crypto, stocks, and your portfolio.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
So, what I've done is built that framework of how crypto is just a macro asset. And it took a long time for people to believe that. They thought it's something different, it's something unique. It's a macro asset. So you apply the same things that I've always used, which is liquidity, business cycle, all that stuff, plus a bit of technicals and sentiment. There's no voodoo here. It's pretty straightforward as an asset. It's just more volatile. So it's harder to deal with. But you were right. What I was seeing was like the liquidity indicators like Global M2 had stabilized and started going up. It leads Bitcoin. Bitcoin was following it almost perfectly. So I was starting to look for the bottom. Then I start looking at stuff like, okay, where's sentiment on NASDAQ? Because it's tech stock, same thing. It was in the gutter.
Right.
Sentiment was the worst I had seen since COVID. That was across the board, across everything. Even hedge fund long short, everybody was max bearish. And I'm looking at liquidity. It's going up. I'm seeing the market getting fearful over a narrative. And I'm like, well, what is the likely outcome here? Are they going to have 150%, a trillion percent tariffs on China? No, they're going to reach something normal. So you've gone from peak headline fear to things could only be better from here. So for me, it was like a no-brainer of an opportunity, both in tech stocks and in crypto. And so going forwards now, normally speaking, this is the period, my framework is about, them rolling the debt and having to provide liquidity to do so. Mm-hmm. And so what we've got is a lot of forward-looking liquidity coming out of whether it's the weakness of the dollar, whether it's other countries using their balance sheets, a number of different mechanisms. And all of that to me is suggesting that the rest of this year is going to be very strong. And I was kind of thinking the NASDAQ was going to be a V-shaped recovery. And my God, it was a V-shaped recovery. And people are still underweight and short. It's a hell of a setup. We overlaid the chart of 1997, the Asian crisis, was a short, sharp shock, versus now it's almost identical. The 4-month period leading up to it, 4 or 5 months leading up to it. And that was a V-shaped recovery as well, because everybody was caught off sides because they thought the world was going to end. Liquidity came into the system. It was via the Fed that time cutting rates and all the other central banks. And the market just went up in a straight line for the next 2 years. There is a risk here that we rerun 98, 99 or 99 because you've just taken all the tail risk. Let's assume that Saudi, the US, and Israel do a deal with Iran. That feels like it's going to happen. Let's say that there will be a ceasefire in Ukraine, and let's assume that the Chinese will come to the table, do something reasonable. Those three things happen. We've taken all of the left tail off the table. And people are going to be like, oh, but inflation's going to come back. And they're going to keep saying that for 18 months, which they kept saying as inflation's fall. So I think it is not a small probability that we have a really blow off kind of next 9 months or so. The last Trump cycle in 2017, we had the same thing. The market corrected in the beginning because everyone's fearing tariffs and the same narrative. The Fed were raising rates and doing the balance sheet runoff. And the market screamed higher all year because the Chinese were stimulating, the Europeans had to stimulate. So it feels like, even if the Fed don't do anything, I still think the Fed cut, but let's assume they don't. Well, that's not a prerequisite for the market to do anything. As you said, as long as rates aren't jacking higher, everything's fine.
While mainstream narratives remain focused on inflation risks and geopolitical instability, Raoul Pal offers a sharply different perspective rooted in macroeconomic indicators and capital flows. He argues that crypto, often seen as a separate asset class, is actually closely linked to the same forces that drive global equity markets: liquidity, sentiment, and the business cycle. When these factors shift, crypto tends to react with greater volatility but also greater upside potential. Pal points out that the liquidity environment is already changing. Global M2, a broad measure of money supply, has stabilized and begun to rise, a historical leading indicator for Bitcoin and other risk assets. At the same time, sentiment in tech and equity markets remains deeply bearish even as prices recover, creating a strong contrarian setup. Hedge funds, institutional investors, and retail traders have been largely underexposed, missing rallies in both crypto and U.S. equities. Pal describes this as a clear opportunity, with liquidity quietly increasing thanks to dollar weakness, central bank interventions overseas, and ongoing debt rollovers, positioning markets for further gains. He compares today's environment to the post-Asian financial crisis rebound of 1998 to 1999, which triggered a surprising V-shaped recovery and a 2-year bull run fueled by central bank easing and improved global coordination. Importantly, Pal stresses that the current rally doesn't rely on the Federal Reserve cutting rates, though that remains a possible boost. Instead, it's the absence of additional tightening and the fading of macroeconomic fears that's driving risk assets higher. From Pal's perspective, we're still in the early stages of a broad restocking of U.S. equities and crypto allocations, a process likely to continue well into next year, especially if geopolitical tensions ease and inflation concerns subside.
We're in the final phase of this bull run. Let me guide you. We've launched Daily Dose Crypto Alpha, a free private Telegram group just for the Daily Dose Crypto family. Inside, I'll guide you through profit-taking strategies, real trading tactics, long-term crypto investing mindset. Only 500 spaces available, then it's closed. If you're serious about this bull run, click the private link to join now.
No, it's real, and I'll tell you why it's real. I've just come back from the Middle East. All of the sovereign wealth funds are now buying. Right, these are the largest pools of capital in the world. We're hearing it out of Saudi, out of Abu Dhabi, out of Qatar, and out of Bahrain. And why that's happening is because the US has become crypto friendly. It's the green light. So the US will get some regulation through. There'll be a bit of a shit show and debating about it and the usual stuff, but they will get some regulation through, which is the clarity that all of the pension funds need. So they're waiting as well. So there is a lot of buying to come from the really big players who've been waiting. Like Goldman has not been able to fully build out its desk, and JP Morgan haven't. They've had crypto for a while, but only for certain types of customers, but they want to build out suites of product, but they've been waiting for regulatory clarity. So yeah, I think it's a big deal. Like the institutions are still either trying to figure out what this thing is. Yeah. Right? I had a conversation with one of the biggest kind of financial asset management firms in the world yesterday, based out of the US. And they're like, they've even got a crypto division, but they're other kind of where they allocate the assets. They're like, we don't know how to deal with this. So they're still trying to figure out what it is. Yeah. Like they haven't figured out it's a macro asset. Others have. The sovereign wealth funds obviously just doing it for diversification of reserves. They're like, it's a technology, it's a diversification of reserves. So if the US is going to do it, we're going to do it. So there's different groups doing different stuff. There is a bunch of people who still don't really want to do the homework on it. They're like, we don't know, it's too volatile for us. But I think usually it's the first mover advantage in this. And, again, it reminds me a lot of back in the day when Goldman rolled out the GSCI index and nobody had commodities in their portfolios, and that team had to go around and sell commodities to everybody. And they would say, the clients would say, but it's too volatile. And you say, yes, but part of a diversified portfolio, it's exactly the same thing, right?
That's right.
It's exactly. And also, we were around when the gold ETF started, and it's the same thing. Everyone was like, holy shit, where did this come from? It became a very, very big ETF. It's exactly the same. What people like to do, because there's so many new participants in the industry, they think it's all new and different. When you've been around as long as you and I, you realize nothing is different. We've gone through all of this before. This just happens to be a bigger, faster moving asset, but it's the same as GSCI was. It's the same as the gold ETF was. It's the same as the NASDAQ was when we didn't understand what the it was and why it went up all the time. It's all of these things combined, right?
What do you think about gold here, Raoul?
So I came up with something, it was only last month in Global Macro Investor that kind of shocked me, hadn't figured out, is that there is a set of dominoes that happen in markets. Financial conditions lead everything. For financial conditions, we use the dollar, rates, and oil, right? The three big financial conditions thing. What we found is that leads like the ISM and other stuff by about 9 months. And it leads liquidity by about 6 months, something like that. Liquidity is what drives Bitcoin and NASDAQ, and it leads it by 3 months. So global M2, let's say, leads Bitcoin by about 3 months. I found out, I was like, what's going on with gold? I put it against against financial conditions. It reacts in real time to financial conditions.
Wow.
I'm like, holy shit, why didn't I figure this out before?
Of all trading securities, right?
Of all the things, well, because it's a pure currency asset, right? It's the pure thing. And so the moment financial conditions ease, gold moves. And so it's leading everything else, which is, we were kind of thinking, is it leading or is it doing something weird? Is it trying to price in some catastrophic risk? No, it was just pricing in the fall in the dollar, the fall, rates didn't really fall a great deal, but the fall in oil.
And I'd throw on, the visible death of fiat currency as, Western nations drive their deficits and their borrowing levels to absurdity. It seems like that's something gold was reacting to on the way up, right?
Well, that's what the financial conditions are in the end. Yeah. It's the debasement of currency. It's the whole thing is the debasement of currency by excess liquidity being pumped into markets by any mechanism possible. At first, they used the balance sheet. Then we all figured that out and called that money printing. So then they did this Fed net liquidity trick, which was the balance sheet plus the Treasury General account and the reverse repo. Yeah. Then we figured that out. And then they moved to total global liquidity, which is including M2, which is stuff it on the bank's balance sheets. So force the banks to buy bonds. That's the game.
Raoul Pal suggests we may be on the brink of a major shift in financial markets, one that echoes past revolutions but is unfolding at a much faster pace. His analysis reveals a quiet restocking of markets by some of the largest pools of capital in the world, including sovereign wealth funds from the Middle East, U.S. pension giants, and institutional banks, all preparing to deploy significant capital into crypto and equities. The game changer isn't new technology but clearer regulatory signals from the US, which are finally giving these institutions the confidence to participate at scale. However, many asset allocators still struggle to fully understand crypto, with some paralyzed by its volatility and others unsure how to categorize it within traditional frameworks. Pal argues convincingly that crypto's rise mirrors previous market revolutions like the launch of the GSCI for commodities or the introduction of gold ETF. Each time, volatility scared off many investors, but early adopters gained a lasting advantage. Today, that dynamic is playing out again, this time with crypto as the disruptive asset class, fueled by favorable macroeconomic tailwinds. Central to Pal's thesis is a data-driven model where financial conditions, specifically the dollar, oil, and interest rates, drive macro outcomes, liquidity follows, and risk assets respond. Bitcoin tends to lag global liquidity by about 3 months, while gold reacts almost immediately due to its role as a pure monetary asset sensitive to currency debasement and financial repression. Powell emphasizes that this isn't just a hype-driven rally, it's a reflection of profound structural changes in the global financial system. Markets are responding to a flood of liquidity, a generation of investors still underweight risk assets, and a growing understanding that inflation, rates, and geopolitics have shifted from headwinds to background noise within a larger monetary transition. Whether this leads to a V-shaped recovery reminiscent of 1998 or another 2017-style bull run, one thing is clear. The market is moving, smart money is no longer idle, liquidity is rising, sentiment remains cautious, and positioning is light. The question now is, are you ready and positioned for what's coming, or will you watch from the sidelines as institutions quietly take the lead? For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.